Hi, welcome to today's meeting, today's wonderful meeting and class. Today's meeting is very wonderful and exciting. So today we're going to be talking about Fibonacci retracement. Don't bother, it's nothing much. I know some persons will be like, what is he trying to talk about? What is Fibonacci retracement? Is he speaking Asia or is he speaking what we don't know about? Fibonacci retracement is very simple and good, and it's something that every trader has to know. Every trader has to know. Every trader has to know. Um, it's known as Fibonacci retracement, and it's not Fibonacci something else. So remember, retracement occurs only in a trending market, whether a market is trending upward or whether a market is trending downward. Fibonacci retracement. So don't even think of using it in a sideways market or a market that is consolidating, but only in a trending market. And I'm going to make it and show you in such a way that it will be very easy and simple for you to understand. Now, before I go ahead, try as much as possible to subscribe to this channel, share on your notifications so that by the time we post or upload more videos, you're gonna see them for free. Now, let's go to the big deal or the little deal or whatever you call it. So let's go to our chart. Now, when you ask the average trader, in a trending market, at what point do you take your entry for a buy or sell? The trader will tell you, on the average, you just say, okay, the nearest support zone or the nearest resistance zone. If it's an uptrending market, he will just tell you, he or she will tell you the nearest support zone. And if it's a downtrending market, the trader will tell you the nearest resistance zone. That's where he take his or her entry for a downtrending market. But for an uptrending market, it tells you the nearest support zone. But the truth is this, sometimes, especially in a strong trending market, you don't expect the market to come back to the nearest support zone. So what else do you use to get your point of entry in the market? That's where the Fibonacci retracement comes in. Don't bother, it's nothing much. But with this Fibonacci retracement, at the end of this meeting, your trading style will shift to the next level. So we move over to why do you use or why do you need Fibonacci retracement? Why do you need these two? It can be used to get retracement points, that's number one. Can be used for your entry, can be used for your stop loss and your TP. Helps one to be conservative in trading. I come again. It can be used to get your retracement points, can be used for your entry in the market, can be used for your stop loss and your TP. And it also helps one to be conservative in trading. Conservative in trading. But before I go into this, I would like to show you how it came about. How we got those numbers. It's not, when I mention numbers, I know some persons will be like, oh, he's trying to talk about mathematics. There's no mathematics in it, it's just the basics you need. And your application is the most important thing and the understanding of it. Now, initially, before now, prices or price was represented in a line chart, just like this. So imagine, have a mental picture where price is still like this. You find out that trading will be somehow difficult for the modern day traders. So then price was just represented in a line chart. There wasn't like a candlestick, there wasn't like indicators and some other advanced tools used in trading. So over time, humans, one of the characteristics of human beings is evolution, making things to get better over and over again. So over time, both physicists, biologists, mathematicians, they came into place. What is it that we're going to do to enhance trading? So that was what gave birth to your candlestick you know today. That was also what gave birth to your indicators. That was also what gave birth to other trading tools in the market. And that was also what gave birth to your Fibonacci retracement in order to enhance trading. And over time, Fibonacci has been working. But the most important thing is for you to understand it. So how did we get it? How did we get the levels? Now remember, Fibonacci retracement levels, they are not just levels in the market. They are not just points of entry in the market. They are also sensitive support and resistance in the market. Support and resistance in the market. So they are not just lines in the market. So how did we get those points of entry in the market, those levels in the market? And why is it that they are not able to work? Now, Fibonacci retracement begins with your 0 and 1. 0 and 1. If you did your mathematics very well, or even though you don't do mathematics, no problem, but if you did it very well, you understand this progression here. It begins with 0 and 1. So remember, your 0 plus 1 will give you 1. Then 1 plus 1 will give you a 2. 2 plus 1 will give you a 3. 3 plus 2 will give you a 5. 5 plus 3 will give you a 8. 8 plus 5 will give you a 13. 13 plus 8 will give you a 21. You can see the progression. So until infinity. So that was what gave birth to this number. So how did you arrive at these numbers? If you are with your calculators or with your smartphones or whatever you are with, now help me with this. Do your 13 divided by 21. It's going to give you 0.61. Converting to percentage is going to be 61%. So 13 divided by 21, 0.61. See, 8 divided by 21 is going to give you 0.38, which is equal to 38%. 5 divided by 21 will give you 0.23, which is equal to 23%. 3 divided by 21 will give you 0.14, which is equal to 14%. So on. That's how we got all these numbers. That's how we got all these numbers. But there's what we call Fibonacci golden ratio. There's what we call Fibonacci golden ratio in the market. Fibonacci golden ratio. Now, when you do 13 divided by 21, it's going to give you 0.61. When you do 8 divided by 13, it's still going to give you 0.61 with that approximation. When you do 5 divided by 8, it's still going to give you 0.61. When you do 3 divided by 5, it's still going to give you 0.61. So what does that mean? It means that this 0.61 that is repeating itself is very important in the market. It's very important in the market. It's very important in the market. So that 0.61 is known as Fibonacci golden ratio. It's known as Fibonacci golden ratio. Please note it. It's very key in the Forex market. By the time we get to the chart, I'm going to show us how to spot these levels. So person will be like, oh, all these numbers is listing. How is it possible? It's very, very possible and easy. So at the end of the day, these are the numbers we got. We got 61%, 50%, 38%, 23%, 14%. Where 61.8 is a Fibonacci golden ratio. Now, I know we didn't get 50. Some persons will be like, oh, how did he get 50? He's trying to scatter me, he's trying to do this, he's trying to do that. But 50% came in place because traders, you and I, if you're a trader, but traders generally believe that when the market is buying, that particular market that is buying, when it starts doing a retracement, it has to do at least 50% retracement. 50% retracement of the initial move before it will continue that direction. What does that mean? If a market is in an uptrend and start doing a retracement, that is, start selling for a retracement, at least it has to sell 50% of what it moved of the initial swing in the market before it will continue the bullish move. Likewise, the bearish move. This is what I'm trying to say. So traders, okay, this is an uptrending market right now. So traders, 50% came in place. You can see this is buy, it bought to this place, bought to this place. Now traders believe that for this market to continue buying, forget about the consolidation happening here, but traders believe that for this market to continue buying, it has to do at least 50% of this initial move. Remember, there must be a retracement in the market breathing in and breathing out from the market. So traders believe that the market must do 50% retracement. At least it must come back to at least half of this initial move before it will continue the impulsive move. So that's how we got 50%. Likewise, the bearish market. So we now have 61%, 50%, 38%, 23%, 14%, where 61.8 is the Fibonacci golden ratio. Now, the next question will be, how do we apply this? You've been speaking a lot, you've been saying a lot of things and saying a whole lot of things. Now, how do we apply this? Because the most important thing is the application and making it more practical. How do we apply this? So now we move over to the practical aspect of it for you to understand how to use it. Remember, Fibonacci retracement levels are used in a trending market, not in a ranging market, not even a choppy market. For you to understand, only in a trending market for the retracement. You can use it for your stop loss and your take profit. You can use it for so many things. Now let's move to the chart. Now before we move to the chart, remember to subscribe, share to your friends, so that and also on your notification, so by the time we upload more videos, it will be easier for you to do what? For you to understand. So now let's get to the chart. Now, for an uptrending market, before we get here, now remember there's a video we have right now on functions of MT4. Functions of MT4. Now, functions of MT4 talks about the trading tools. Now, trading tools are tools we use in analyzing the market or doing analysis in the market. And where are they found? They are here. So, Fibonacci retracement tool is one of the trading tools. Here you see the crosshair, you see the vertical line, you see the horizontal line here, you see the trend line here, you see the equidistant channel, you see the Fibonacci retracement, and you see so many things around here. But the one that is needed for your Fibonacci is this one. You can see draw Fibonacci retracement level. So easy. So I want to know where this market will buy to or will retrace to before it will continue its bullish move. The possible places the market will retrace to before it will continue this buy for a buying market. For a buying market. So how do I do that? I pick my Fibonacci level. Then for you to draw it, for an uptrending market, draw from the nearest swing low to the nearest swing high. I come again. For an uptrending market, draw from the nearest swing low to the nearest swing high. For an uptrending market, draw from the nearest swing low to the nearest swing high. That's the easiest. So the nearest swing low to the nearest swing high. The obvious low to the nearest or the prevalent market price where you find it. So what I do, this is the nearest obvious low I'm seeing here. So I take it to this particular high here. Oh, you can see very easy. I come again. Let me go pick it again for you to see. All I do is to come here, pick it, take it from here, drag it to the nearest highs. You can see, very easy. When you pick it, you come here, you right click as to hold, drag to the nearest high. So that's how it is. You can see those levels, 23.6, 38.2, you can see 50.0, you can see 61.8, 23.6, 38.2, 50.0, 61.8. Very simple. Now, there is possibility for this market to stop at this 23.6 and continues the buy. Remember, when it stops here, that does not mean you should go and buy. You have to wait for confirmation, candlestick confirmation. You can see this buy that is happening here is as a result of the candlestick confirmation here. but there is possibility for the market to stop at 23.6, give confirmation and continue buying. This is a zone in the market. Most of the times market expects 23.6, but should in case it breaks 23.6, it's headed to 38.2, giving you confirmation before you buy. If it breaks 38.2, look at that 50 we talked about. 50, that is 50% of this movement. There's possibility for it to stop here, give confirmation and buy. Then this is the Fibonacci golden ratio, which is 61.8. When it gets to 61.8, 61.8 is like is very much reliable. Is very much reliable, and most times it correlates with the trend line. 61.8 is very much reliable, and most times it correlates with trend line. All you have to do is when the market gets to 61.8, allow the market to give you a candlestick confirmation, bullish candlestick confirmation, before you buy. And one other good thing about this Fibonacci is this: it will help you to know when a market has reversed. How do you know? If the market breaks, or if price breaks this is 1.8 heading to 100, it's trying to tell you that there's possibility that the market has done. If it breaks 100, that means the market has done what? Reverse. But if it stops at 61.8, it gives you a confirmation. Don't even look back. You can, provided you're in the direction of the trend. And remember, the same rules that applies to any strategy you use still applies to this one. If you're a scalper, go to your higher time frame for this. If you're a day trader, go to your higher time frame. If you're a swing trader, go to your higher time frame. If you're a position trader, go to your higher time frame for what? For analysis. So when it comes to 61.8, gives you a confirmation, you buy. Then you set your, if you buy here, your stop loss will be, you can set your stop loss directly below, not at 61.8 because of stop hunt. There's what we call stop hunt, but slightly below 61.8. That's where you set your stop loss, slightly below 61.8. So Fibonacci can help you to understand where to set your stop loss, slightly below 61.8 for your buy in the market. So let's pause something like this too and practice it again. So this is Euro USD. Let's move over to GU, which is the GBP USD. So let's say we want to draw for this. Let's say we want to draw for this. Let's say we want to draw for this. Remember, you go here, you pick your Fibonacci level. So where do you place it? Where do you place it? You remember, swing low to swing high, not from swing high, not from up to low, but from low to high. So you take it from here, from this low, hold, drag to the upside. You can see it, right? From swing low, hold, drag to the upside. You can see, very easy and simple. Very easy and simple. Hold, drag to the upside. And you can see 23.6, 38.2, 50. So these are levels the market possibly get to before it will consider the buy. You can see the market got, there's possibility for the market to get to 23.6 and continue the buy, or come back to 38, 50, or probably 61.8. Stop loss below. Then if it breaks 100 coming down, it means trend has downward reverse. As simple as that. It's never hard. It's never hard. It's never hard. It's never hard to spot. And to even make you to be more conservative instead of entering the market aggressively. So we move over to the hand trending market. How do you use the hand trending market? The hand trending market is just the direct opposite of this. You don't take from low again, but you take from the highs. So let's move over to the hand trending market. Let's look for the hand trending market. So let's see if we can move over to the USD Canadian dollars. USD Canadian dollars. Okay, now you can see a good hand trending market here. Now for this type of market, remember it's going down, and what you are thinking of doing is exclusively selling the market and not going long for the market, but selling the market. So what do? Or shorting the market. So what do? You go here, pick your Fibonacci level. The nearest highs, nearest obvious highs, look at it here, nearest obvious highs. So you drag it from there, take it from there to the nearest obvious low or the swing low. It's as easy as that, to the swing low. You can see it. So possibly you wait for the market, maybe what you are waiting for is for the market to come back to your 23.6 before it will go for a sell, or your 38.2, or your 50, or 61.8. But wherever it comes back to, it must give you a confirmation. If it comes back to this 61.8, you wait for a candlestick confirmation before you enter the market for a sell. So you expected something like this, then your stop loss has to be above. But if it does not get to your 61.8, if it doesn't get to your 61.8, you can as well allow or wait for it at 50, or you wait for it at 38.2. You might confirm at 38.2. If it confirms at 38.2, what do? You use your trend, you wait for confirmation before you follow that particular direction. I go again for another practical. So move over to USD CHF. Let's see if we can see something than trending. Okay, remember every currency pair have their uniqueness in the market. Now look at this. So what do? I pick my crosshair, my Fibonacci level. Look at the obvious high I'm seeing here. So look at, I drag it from there to these lows. You can see the market is at 23.6 already. 23.6 already. So there is possibility for you to stop at 23.6, continue the sell. But remember, you have to wait for what? Confirmation. If it doesn't confirm here, if it breaks above, there is a possibility for you to get to 38 or 50 or even 61. But the most important thing is for you to wait for what? Confirmation at every point in time before joining. If it gets to 50 and gives you confirmation for a sell, that means there is possibility for you to go down. Remember, all these things work hand in hand with your fundamentals, but your 61.8 is known as Fibonacci golden ratio. Most of times it plays out, and it will continue to play out. 61.8 is very conservative and works hand in hand with trend line. 61.8 very conservative and works hand in hand with trend line. So look at more for 61.8. But in a strong trending market, you don't expect the market to come back to 61.8, not even 50. Most times in a strong trending market, that's where the 23.6 works. Just like what we saw in Euro USD. You can see how strong this market trended. So you don't expect it to come back to 61.8 for a buy. You don't expect it to come back to 61.8. You can see how strong the market trended. You don't expect it to come back to 61.8 here, except on fundamental reasons. But most times you see it stopping at 23.6 for a strong trending market. You see it stopping at 23.6. But for fundamental issues, sometimes you see it getting to 61.8. Whichever way, but you must have confirmation in the market. 61.8 is very, very nice for entry, especially in a healthy trending market. There's what you call healthy trending market, but for a strong trending market, you don't expect the market to come back to 61.8. Only in a healthy trending market, you expect the market to come back to 61.8. But in a strong trending market, you don't expect the market to come back to 61.8. Those ones are also there. So drawing your Fibonacci is very easy in the Forex market. Very much easy in the Forex market. So as a form of recap, as a way to recap in the Forex market, as a way to recap from what we've been doing, I started with the Fibonacci retracement. I went ahead to the things why we need them, can be used to get retracement point, just the way I showed you, can be used for your entry in the market, can be used for your SL and TP, helps one to become conservative in trading. I went ahead to show you how we arrived at 61.838%, 23%, 14%, and how we got 50%. Remember to subscribe, share, on your notifications, so by the time we upload more videos, you're gonna learn more. Fibonacci retracement is very good. One of the ways to be profitable in this forex trading is practice, 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 and practice. It's not just by listening, following whatever you see, but to practice and practice and practice. So this is what we have today. So love you. Wait.